Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson.
Financial ratios. Financial ratios are numerical values that help investors and analysts evaluate the performance, profitability, efficiency, and solvency of a company. They are calculated by dividing one financial metric by another, using data from the company's financial statements. Some of the most common financial ratios are earnings per share, EPS. This ratio measures how much profit a company generates for each share of its stock. It is calculated by dividing the net income by the number of outstanding shares. A higher EPS indicates a more profitable company. Price to earnings, P ratio. This ratio measures how much investors are willing to pay for each dollar of a company's earnings. It is calculated by dividing the current market price of a share by the EPS. A lower P ratio indicates a cheaper valuation, while a higher P ratio indicates a more expensive valuation. Return on equity, ROE. This ratio measures how well a company uses its shareholders' equity to generate profit. It is calculated by dividing the net income by the average shareholders' equity. A higher ROE indicates a more efficient use of capital. Current ratio. This ratio measures how well a company can pay its short-term liabilities with its current assets. It is calculated by dividing the current assets by the current liabilities. A higher current ratio indicates a better liquidity position, while a lower current ratio indicates a higher risk of default. Debt to equity, D/E ratio. This ratio measures how much debt a company has relative to its equity. It is calculated by dividing the total liabilities by the total shareholders' equity. A higher D/E ratio indicates a higher leverage, while a lower D/E ratio indicates a lower leverage. Financial ratios are useful tools for comparing different companies in the same industry or sector, as well as for tracking the changes in a company's performance over time. However, they should not be used in isolation, as they may not capture the full picture of a company's situation. They should be complemented with other qualitative and quantitative factors, such as industry trends, market conditions, growth prospects, competitive advantages, and risks.